There we go. So, who am I? I am Roham Rezai. I'm a first-year PhD student here at the School of Banking and Finance at UNSW. I'm from Iran. I did my Bachelor of Science in Civil Engineering at Iran University of Science and Technology. I got my first master's in business administration from a business school in Netherlands called TIAS. Then I worked for a portfolio management firm in The Hague, Netherlands. And then I came back to academia. I think I was always meant to come back to academia. I started an MPhil degree in finance again at Erasmus University in Rotterdam, Netherlands. And after that, I moved to here. I came to Sydney, started my PhD at UNSW, and here I am on 17th of September 2020, delivering this tutorial session. My research focus is on corporate finance, innovation, private equity, and venture capital. So basically, the topics, the discussions we are going to have, they are really, really exciting and interesting to me. And if you ever want to talk about any of them, if you have any research ideas, or if you have any interest, if you see something in the news that you think is kind of related, please let me know if you want to have a chat with me, and or also if you want to discuss them in the class, that's definitely an option. To reach me, you can email me. This is my email, r.rezai@unsw.edu.au. I check my emails once a day, so you can expect a reply within 24 hours. And for professional and record-keeping reasons, it's essential that you contact me via your student emails. And so I apologize in advance, but I would not reply to Gmail or Hotmail. And please also keep your queries focused on tutorial content and admin issues related to the tutorials, as well as the assignments that we would just talk about. So this course is about examining venture capital and private equity investments. It focuses on basically young firms, entrepreneurial firms, and how they seek financing, how venture capital or private equity firms, they provide financing to them, how those firms basically value these, if you like, startups. And probably the difference between this course and the courses you have had previously is that we depart from the usual approach to risk and return of publicly listed securities, and we focus more on private markets, and we analyze issues that are related to financing growing and innovation intensive private businesses. That is the whole direction of this course. The teaching team comprises of Peter Pham, who is the lecturer in charge, Simon, who I think probably yesterday you have had your first lecture with. He has lectures on first week, second week, and last week. And the rest of the lectures are delivered by Nick Turner, who is a PhD student, another PhD student 1 year above me. And he's also the tutor for other sessions, and I am your tutor for this session. And obviously, due to the COVID-19 pandemic, we delivered this course in an online format. There would be weekly lectures, And in these lectures, you are introduced to new topics. And then in tutorials, between week 1 and 8, we collectively discuss a case on those topics that have been covered in the lecture. And there would be some questions that will be posted on Moodle, and we will try to tackle those questions, discuss them together during the session. So what is required from your side is to read before each tutorial session, to read the cases and attempt the questions. In the beginning of each session, we have 10 minutes presentation on case facts, who are ideally presented by yourself. So these would be like 10 minutes presentations with 2-3 slides. And I'm looking for people who are volunteer to deliver these cases. And it's very interesting. It basically will help with your presentation skills. It would help with you being able to summarize a case. And probably I know that none of you care about that, but there is also a 1% bonus mark that you can get if you present. Not that is the most important aspect, but that is something that you can also consider. And so in order to basically, if you are a volunteer, please email me your name and 3 candidate sessions that you want to present the case for, because other people would also volunteer, and it's very likely that the session that you have requested to present for, it's been already taken. It's on a first come first serve basis. So just send me an email with the session that you would like to present, with 3 sessions that you would like to present, and I will get back to you with assigning you to one of those sessions if they are available. During the tutorial sessions, we will discuss questions, case questions. They will be discussed in smaller groups, and sometimes we discuss them together as a collective group. Probably you have had this practice in your other courses, but you will get a flavor of this today. And it is really in your best interest to prepare for tutorials beforehand. Obviously, that is how you can maximize your learning as well as your participation grade, which is 10% for the tutorial sessions. So it's not sufficient to attend to these classes only to earn this grade, but you need to provide quality feedback, quality comments. You need to volunteer for group presentations, which, for example, this week we would break into groups at some points, and then we would need people who would volunteer to basically present to us how their discussion went. So I really encourage you to take part in these kind of activities, because it would not only really like it's to be very honest, it's not really only about the grade. It would make the experience itself really more enjoyable, both for you and for me. When the class is interactive, I personally enjoy it much more. Okay, let's discuss the assessment structure. So as I said, there is 1% bonus mark. So this course, there are 101 marks in total. And that 1% extra goes to people who volunteer to present their case facts. They will receive that bonus mark. In terms of class participation, It will be recorded throughout the term based on the quality and not quantity. So first off, it's not sufficient to just attend for participation mark. You need to attend and you need to provide quality questions, or you need to make smart comment remarks. So that is what will get you a higher participation rate. And yes, so obviously, questions that just clarify admin issues, they're not sufficient for getting a high participation mark. There is also the investment evaluation report. We'll talk about it more in detail the coming minutes. It has two components. The first component is due at the end of week 5. The final report is due at the week 8. And I highly suggest you to start on this early. And there is also a simulation activity. Let me just write down something. Okay, sorry. There is also a simulation activity which comprises 10% of your grade. It would happen during tutorials of week 9 and 10. We will talk more about it when we are closer to those dates, but these two activities, the investment evaluation and simulation activity, they would happen in groups that ideally you have formed them yourself. But if you could not manage to get a group, I will allocate you to a group. I will just talk about it. But so basically, this simulation activity is where we split up into so each group would get either a role of a venture capital firm or a role of a company that is seeking financing from that venture capital. You would try to negotiate together. So it's kind of a simulation of a real world case that happens in reality. Basically, companies, they would try to negotiate with the venture capital firm to get a higher value for their company and for their funding, and venture capitals, they want to get a lower value on the deal. But there is a lot of negotiation. They discuss the company, the business together a lot, and this is what we are trying to simulate in that activity. There is, I will just talk about the group formation, Ashwin, in the next slide. There is also final exam, which comprises 50% of your grade. It's a limited duration take-home exam, and it's done on Moodle. It comprises of multiple choice questions as well as written answers, and it will be submitted via Turnitin. And it covers the entire content of the course and will include reflections of other previous assessment tasks as well. So it has this holistic approach, and this requires that you really care about everything, like in tutorials, as well as the lectures themselves, as well as the assignments. There wouldn't be any opportunity to return to previous questions. I guess probably in the last 2 terms you have done these kind of online assessment tasks. And so questions are also randomized for different participants. That is the whole structure. So as I said, as you can see, there are 101 points here. And yes, that's it. As I said, for 2 activities in the course, 2 of the final mark components, the simulation task as well as the investment evaluation report, you would need to do them in groups. Your groups must have a minimum of 2 students and a maximum of 4. So groups are either 2 or 3 or 4 students, and there are no exceptions to this rule. And all students must form groups within your own tutorial. So, for example, right now we have 22 participants, and you have to build your groups within this 22 participant. Oscar is asking whether he can make a sheet to record groups, so it's easy to find a group. Yes, of course you can do that, but I suggest that you do it internally. You can just use a chat box if you make a sheet so that you can just share it with everyone. But yeah, this is something that is related to yourself until week 2. So by the end of week 2, if you don't have a group, I would have to allocate you to a group. But please use any like online Excel sheets or like Google Documents or anything which you would like. But what you have to do is just email me your group members, their ZID, as well as your session time. So ideally, let me first. So this is my email that you need to send me your group members to. And so in your email, please mention your group members, your ZIDs, and your session time. And as I said, groups are either 2, 3, or 4 students. And hopefully by the end of this week, you have your group. If not, by the end of week 2, I will have to allocate you to a group. In the group activity, there might be some conflicts. You may come to some serious disagreements. So what I personally think should be the right approach initially is that you should try to resolve them internally. But if that couldn't happen, please just raise them to us as soon as possible, to any of the teaching staff. And in order for us to also help you, please keep record of any issues, including allocations of work. So even before that there is an issue, please try to keep record of discussions of allocations of work, timeliness, and completion of work. And if there are any serious issues, please raise that to us as soon as possible so that we can try to fix it together. That's it, I think, for the group. Do we have any questions at this point? All the information and all basically you can see the course structure online, and all of them are available on Moodle. At the moment, I would just like to go through the investment evaluation report and what is expected of you about that. Let me just share with you this file, which is available on Moodle as well. So this Word document, you can find it on Moodle. It's about the investment evaluation report. So this investment evaluation report, its objective is preparing a funding proposal and recommendation on a new investment opportunity that the venture capital fund that you're working for is considering at the moment. So the scenario is you are working as an analyst team. Your group is working as an analyst team for a venture capital firm or private equity fund, and you are tasked to provide an analysis and recommendation on a new investment proposal, which has been already pre-screened by the partners. So there are 4 candidate companies that your venture capital fund wants to basically fund them. The first one is this Pullmanx, which is a company in surgical and medical instruments and apparatus industry. We have Ucommune Group, which is in Office of Trades and Services, PCI Media in motion picture and videotape production, Valtech SE in computer programming services. They are actually thinking of going public, these companies. These are all real US companies. They're thinking of going public, and in US, if you have that intention, you should file this IPO filing with SEC, which is the regulatory government body which oversees IPOs and basically whatever it's related to financial markets and stock markets. So you can find the official documents about these companies here, and this is where I would use as the backbone of my information, because this information is structured and standardized so that it would meet the SEC's standards. There are some assumptions that you would need to incorporate in your models. I would just leave them up to you to read them. As I said, you would need to build these 2, 3, or 4 student groups. And if you cannot find a group member by the end of week 2, then I will have to assign you to a group. You are required to have weekly meetings. This is something that you should do it on your own. But what we can do together is that in certain weeks during tutorials, there will be compulsory group meetings where you would work on the assignment, and I will also give you feedback on it. In terms of the contributions and responsibility, I personally think it's very important that you clearly set out the expectations for workload in your assignment plan initially. And basically, if we find out that there are students that, or like you tell us that there are students that have not contributed fairly and reasonably to the group, there would be some, we would penalize in terms of a reduction in their final grade. And as I said, it's very important that you bring conflicts in your group as soon as possible. If more towards the term, our hands would be tied in terms of helping you with that. Then you would need to, eventually what is asked from you is writing this investment proposal, which has 5 different sections. So you need to have an executive summary, a background, which this background, you can think of it as an interim report. It is due at the end of week 5. And here you would basically address more qualitative stuff, such as who are the current owners of the company, who is the management team, what is their compensation, who are the personnel. And also you, for example, would talk about in which market is the company active and what are its products and operational strategies. So these kind of questions, you should address them in the background. I would say that this part is more of a qualitative nature, whereas in part 3 and 4, you would basically try to value and price the company based on peers and comparables. And here is where you would have your own derivations, and you should try to justify your derivations. For example, you would have cash flow projections, and you should try to justify such projections. And then in the end, you need to come up with a price and justify that as well, because that is the whole objective, is how much is this company worth? How much should the deal go through? So you also need to, for example, mention the type of securities and funding terms, and you need to justify them. In the end, you would also need a bibliography, which is not very common if it's a real world report, but because it's an academic report, it's required here. There is any additional stuff can go into appendices, but you would also need to have this Excel model. It's not graded on its own, but it's needed for reference and to see how your computation, how have you derived stuff. So you would need to also submit that. And so one suggestion would be that try to basically add extra insight and extra information for your report, and basically do not simply repeat the information in the CC filings. Try to set different pieces of information together and then come up with something new and build on that, because that is what the whole private equity venture capital funds are about. Basically having this assessment and justification of how much a company is worth and how it should be financed effectively. The final report has this 3,000 word limit. The interim report, it also has a word limit, but we will let you know about that. And there are some additional resources that you can use. Excuse me, on top of the SEC filings, which I highly suggest that you use them. Excuse me. Yes. The assessment criteria I've mentioned here. The due dates, the interim reports, it's due at Friday 17th at 5 p.m. And final report is due at Friday 6th at 5 p.m. And you must submit them via Turnitin via Moodle page. And if you have any questions at any point in time, please feel free to ask any of us in the teaching team. And yes, I hope that you have a pleasant journey and also enjoy this task. Any questions about the big picture of the investment evaluation report? This is available on Moodle, so you can go through it yourself. And if you have any questions in coming weeks, you can discuss them again. Okie dokie, let's go to the case that we will be discussing for this week. Okay. So this week we will be discussing Yale University Investment Office, and we will be discussing these 4 questions. Basically, the differences between Yale's strategy in private equity with other asset classes, for example, real estate. How has the investment office decided when to make private equity investments? The differences between the Yale's approach in domestic and international market, and how that can affect its return. And basically how in general the private equity industry is changing, and what could go wrong in the strategy of Chief Financial Officer Steven Swenson, and also how should the investment office react to changes in the private equity market and because of its strategy. So this week, I will do the case facts myself. I think we didn't have any volunteers, right, to present this week case fact. I know that, so next week, I think Oscar has volunteered to present the case. But in the coming weeks, please, as I said, just let me know if you're volunteer to present next week's cases. So about the Yale, we know that it's an $18 billion endowment. That's a massive number. And there has been rising pressure on Yale to spend more of its endowment. Basically, Yale is a private university, but even private universities, they receive in state some kind of funding, much less than public universities, obviously, but still they receive some funding. But even that funding is shrinking. So Yale needs to kind of compensate with that by having a supporting fund, which is this investment endowment fund. Also, the big outflow from that fund, the very large part of that, it's spent on faculty salaries. And whenever you're paying salaries, you're becoming vulnerable to inflation risk. Another expenditure from that fund goes to campus infrastructure, and on basically Yale endowment fund is mandated to each year put aside 5% of its endowment per annum. So all of this, it pressures the endowment fund to be firstly very active and also to spend a great amount of money. But Yale endowment fund has not failed the expectations. It has a strong track record of performance. So in the last 15 years, it has generated a return of 14.2%, just 2.7% above peer schools, and 4.3% above all universities. By peer schools, we mean other Ivy League schools in states, for example, I don't know, let's say Princeton, Harvard, MIT, and these schools. And Yale has outperformed all of them. And it has found its way in top 1% of large financial institutions over this period. So brilliant track record. Yale invests big time in private equity. It's an important element of Yale's portfolio. It's been an investor in private equity since 1973, and it has had these repeated investments in partnerships formed by select group of organizations, and it has this emphasis on value-added strategies. And also it emphasizes very much on strong focus on alignment of incentives. So basically, if managers of the funds that Yale invest in, they perform well, they perform desirably as to what Yale basically is seeking for, Yale makes sure that they are also compensated generously. And based on this investment philosophy, Yale has had a spectacular success in private equity. So it has generated 31% over the last 29 years, which is well above benchmarks, and it has had success in venture capital as well as buyouts in oil and gas industry. But there are worries. Mainly because there has been a fund influx, mainly in 1980s, where when private pension funds basically came to the arena of institutional investment, as well as late 1990s, where there was an inflow of public pension funds in terms of institutional investment. This means that there has been more supply of fund in the private equity market. It has expanded from $4 billion in 1980 to $300 billion in 2004. So 75 times more the pool of private equity in 2004 compared to 1980. And it means that funds are much larger now, but at the same time, this means that market is more crowded. And this could inflate deal values and reduce returns. If we look at the investment portfolio of Yale, we see that this is the 2013 allocations. We see that Yale has invested about 4% in domestic equity. And basically, domestic equity, we are talking about US equity market, which is by far the largest in the world. But Yale is exposed about 4% to that market, whereas other universities, they have invested about 20% in domestic US market. In terms of foreign equity, Yale has invested 11%, whereas other universities, they on average invest about 19%. And in terms of bond, Yale invests almost half of what other universities have invested in United States. So if Yale is not investing in domestic equity and foreign equity, if it's not investing in bonds, where is it investing? The answer is in real estate and private equity. So Yale has invested almost 3 times more than normal, let's say, university in States in real estate. And it has invested almost like more than twice in private equity compared to other universities. And where, for example, if you even consider other large universities, as I said, let's say Harvard and Princeton and these other universities, none of them can basically come close to the Yale's strategy in terms of real estate and private equity. Yale has a similar investment in terms of cash, natural resources, and absolute returns to other universities. But as I said, a completely different approach in real estate and private equity. But this is because of the investment philosophy of Yale, which is built on these kind of 4 values. So basically, university outlays are primarily salaries. And as I said, inflation risk is a concern for anyone who is paying salary. They should really care about inflation because salaries need to adjust themselves with inflation. So the question there is that equity versus fixed income, which of them really can protect you against inflation? The answer can be, for example, maybe both of them, but at the same time, you also want to diversify. That is another component in the strategy of Yale. So they have really limited their exposure to any single asset class. And in general, they avoid timing short-time market fluctuations. So the case starts with this quote from where's the case here? Starts with this quote from Chief Investment Officer David Swensen that anointing winners and losers on the basis of 12-month worth of performance is silly in the context of portfolios that are being managed with incredibly long time horizons. So, as I said, Yale has this very long time horizon. It's an educational institution with, I think, at least 200 to 300 years of history. So. And its endowment, it's not focused on short term or maybe even medium term, let's say even not 10, 20 years. Its time horizon is much longer than that. So that case, maybe it doesn't make sense much to focus on short-term market fluctuation. But the only exception is that if they can spot a persuasive case of misvaluation, then they will go after it. And I think by now probably you have some ideas that Yale, because of all these reasons, if we talk about misvaluation, we're implicitly referring to kind of a market inefficiency. Because if markets are really efficient, we shouldn't see actually considerable or real cases of misvaluation. But Yale does not believe much in market efficiency, and that is why they seek to put money to work in inefficient markets. So their justification or how they show, for example, that markets are not efficient. I mean, their objective is not like making a theoretical argument against efficiency or inefficiency, but how they see that inefficient market in their eyes are basically more profitable than efficient markets. It's by comparing the performance of managers in probably less liquid markets. So, for example, if you sort the performance of managers in private equity markets, how much return they have generated in last year, sort all the fund managers in US on one side in private equity market, and on the other side sort the performance of all managers who are dealing with public equity. So they are dealing with stock market and so on. Then you would see that the top performers in the public equity markets, the fund managers, the mutual fund managers, or the hedge fund managers in equity markets, in public equity markets, they are not really, they don't have much difference in terms of their performance to lower quality managers. So let's say the best manager last year has generated, let's say, 20% in equity markets, in public equity markets, and the worst manager in public equity market has generated 10%. Whereas if you compare the best performers in private equity markets, what you would see is that, for example, the best manager might have generated 70-80% return, while the worst manager might have generated 5% return. So you can see that if you go with very top managers, if you have access to the best private equity and venture capital firms, you can generate much higher returns. That is the justification for them to go to those markets. But is this difference in performance of managers, is it sufficient to determine market inefficiency, support Yale's strategy? Well, that's another question. Also, Yale believes very much in external management. So they actually find managers they do a very thorough research on analysis of capabilities of different managers. They do a comparative advantage. They look at their performance and reputation, and then they find these external managers and give them full autonomy to implement strategies as they see fit. And they have this significant focus on aligning incentives of these managers with that of Yale. So as I said, Yale has its own peculiar investment strategy, and if managers can fulfill that, there would be high reward for them. And Yale has this significant focus on structuring external management contract also to mitigate risk. So they have these separate account structures. Okay, so now we can break out into groups and we can discuss the following questions. So we at the moment, we are 23 people. We can break out into, let's say, we'll break out into 4 groups, and the first 2 groups, they would discuss question 1, both parts of question 1. So first 2 groups, they would discuss both of these questions, and group 3 and group 4, they would discuss both of these questions. And then I will join your groups. I will assign a person to or I will first ask if there is anyone volunteer to represent the group when we are back in the main room. We will discuss these questions for about 10 to 15 minutes, and then we will come back to the main room where group representatives, they will just present how their discussions went. And yes, James?
This might be a bit of an obvious question, but I was just wondering how fixed incomes protect against inflation. Because wouldn't they move, like the price of fixed income move down when inflation's high?
Yeah, well,
interest rates.
Yes, they do move down or up against inflation, but firstly, they do not move as much as equities do with inflation. The correlation is much lower, and also, especially for example, when you're thinking of paying salaries, fixed income can basically secure that kind of fixed income that you're looking for paying salaries. That is why people, when they want to hedge against inflation and they have these salary obligations, I saw a pop-up note. Yeah, if it is adjusted to inflation, then it can be used. But as I said, so a lot of pension funds or like this university endowments, they invest largely in fixed income. But as I said, this is not the approach that Yale is taking. Compared to other universities, they invest much less in fixed income. Does that answer the question?
Yeah, that makes sense. So if it's adjusted for, especially, then like that would help. Yeah.
Okay. So, and if the breakout group activity is clear to everyone, I will just sort out the groups, and probably you wouldn't see these slides when you're in your group. So maybe you can just take a screenshot so you know what you're discussing. It's 10 to 4. Let's say let's aim for 5 past 4 when we are back in the main room.
How's it going?
Good day.
So, wait, what are we discussing? All of them or just some?
Yeah, I think it's some of them.
Right. Well,
it's not allowed to share video. That's what we've got to try to share it. That's what it is.
Maybe you need like permission or something. No idea. Yeah, I don't even. You can share screen, I think, or something.
Yeah.
But you can't. Oh, well. Have you done them or like these questions or looked at them or?
Yeah, I've had a quick look, but yeah, just a quick look. It was like the case is so long and the questions seem like are like really specific. So I read the case and just did a bit of a summary, and then
same
questions now. So
yeah, I just wrote notes relevant to the questions below, like the questions. But for some of them, it was a bit hard to like find specific examples. I found, like for example, the international strategy. Well, they haven't really got a proper strategy yet because they weren't. They saw it as very risky and weren't sure how to exactly do it, I suppose.
Yeah, 100%. I just thought the only like discussion about international strategy was more that of their focus on, I guess, only employing and partnering with the active managers that had investment thesis that aligned with their views and willing to adopt the incentive structure and that sort of thing. But that's just very similar to the investment. So I guess it's not a point of difference.
What was interesting I think they needed more screening with the managers they employed, because, well, you know, obviously if you're investing in emerging markets, nothing's as structured or regulated as it is here or in the US or something like that. Yeah. So I suppose if that's a different strategy, you know, more due diligence in hiring people, or even like potentially not hiring people. Although I think they're like all about, you know, the locals know what's best. So
yeah,
however they do it, it definitely just have to be more screening.
Yeah, 100%. And then it's hard though, because I guess if there's not the same amount of capital allocation and capital in the Canadian VC markets for these developing, it's like, is there the cost benefit to warrant this sort of further screening and further increases in like corporate governance? You know what I mean? Like, it's only allocating $70 million.
Yeah, and even if you get
is it worth it? Like,
yeah, because then, like, what if the government takes over your, you know, you got that country risk if they just...
Yeah, you got the regulatory risk, yeah.
Yeah, they just take over your assets. See you later.
Yeah.
Oh,
sure.
I think with that question, I guess that's the sort of things we can discuss. You know, it's a bit, they have to just be more cautious. Whereas like investing locally, they have more information, easier to break into markets, that sort of thing.
Yeah.
What about question 1? What did you think of that?
Differences. Well, basically, what did I write? Oh, does anyone else have any other thoughts? Anyone want to put their mic on before?
Yeah, if anyone wants to jump in. Thought I heard someone else talk at one point.
Yeah, maybe. I just didn't want to like just talk over people.
Yeah, exactly. Yeah, well, go ahead, I guess.
Yeah, of course. So it was the difference between strategies. Yeah, so I obviously with like real estate, it seemed like it was a direct investment, like as was the case with the 717 Fifth Avenue. And they basically just make their private equity investments through becoming like a limited partner in a series of independent, leading and trustworthy like PE funds. So they basically just entrust their capital with the active managers. But like you were saying with the international opportunities, they really screened the managers a lot. And then they really, I thought it was interesting and obviously smart because it mirrored their long-term time horizon, but to partner with managers that they knew they could maintain a long-term relationship with rather than just a few deals.
Yeah, because then you get those, like if you get consistently outperforming managers, then they'll get all the deals and then you get that long-term fees.
Yeah, exactly. And
I thought,
that's a lot of the underlying reasons of one of the ways that you can have a competitive advantage in this private market as well is the relationships that you have, because it was just saying obviously that because Yale is such a large player in the market now, like due to their experience and their reliable capital, that they have access to a lot of opportunities that wouldn't otherwise be available.
Yeah, 100%. And I think that's an issue they faced in real estate. Like initially they didn't, you know, because they weren't really in that field, so they had to, when they were trying to break in after the Fifth Avenue, or was it Fifth Avenue or something like that, one of those avenues. After their direct investment, I remember they were trying to get some partnerships as well, but initially it was all like big firms, and you know they don't like big firms because of the incentive, like it doesn't really match up with theirs, and you know the bigger the firm, the less monitoring and stuff like that. So but then they got lucky because it broke apart. I forget why exactly, but a lot of smaller firms were able to pop up because of some crisis or something that happened.
Yeah, for sure. And I think I was trying to figure out, because from memory, it didn't explicitly say like why they were so against to the large financial institution. Yeah,
it was a bit... I found that hard to read as well. Like they kept saying, oh, it doesn't align with incentives or something like that.
Yeah.
It was a bit... I think for the oil, they made it more explicit, like... if I can find it.
Yeah, I think, but I was just thinking more to do with the fact that they're very short-term profit-oriented, and the management would be financial institutions, like they really think they were more probably inclined to the financial engineering than the value added.
Yeah, I think you're right, because all those firms have to meet structures, like the quarterly reporting or something like that, have to outperform every quarter. How are you supposed to do that? Yeah.
Right, exactly.
Well, so that's basically it, I guess. And also the bigger firms, they get more comfortable just being big and growing the asset base rather than actually seeking higher returns.
Yeah, for sure. And there's less, I guess there's less incentive for them as well to like respect Yale's wishes as the incentive and just the ongoing relationship. Like it's pretty corporate, and I'll probably share it right through the clients. But
yeah, they got thousands of connections. Why would they need Yale? Like, whereas the small firms would be appreciative of Yale.
I think that a lot of them acted as like a Yale was their most significant and sometimes like only client. So that's definitely different in terms of like client relationship management and that Yale would have.
Yeah, 100%. And then I guess private equity industry, how's that changing? Question 3. Is anyone's there? Do they want to join in? Otherwise, like we're happy to keep going, I suppose. I suppose not.
Yeah, what are your thoughts on that?
Well, it's a lot of what Rohan said, like with the industry becoming more flooded with funds, and a lot of funds are pursuing later stage deals. So overall, the deal valuations are bigger, and then the returns are lower because it's all late stage stuff. So if you take a company from seed to IPO, it's huge return potential there. It's 10, 20 times versus 1 to 2 times when it comes to taking a company that's in like an LBO or something like that, where you just fix it up, or if it's just before the IPO stage, taking it to the IPO, the return you get there is much lower. So I think the industry is just a bit more saturated than it once was. And that could be like a headwind for the private equity strategy going forward in terms of outperformance.
Yeah,
that's all I got, I suppose.
Yeah. I also looked at, I guess there's more sort of from the lecture material as well, is it? There's an interest in the trend of retail investors to enter these private markets, and they're just obviously doing that through either just like a PE sort of ETF or just an offering from like sort of a crowdfunded offering.
Yeah, that's interesting.
Yeah. And I sort of looked at it from, because for the most part that Yale, the investment offers, gain their superior returns by targeting the albeit more risky but more inefficient markets. So obviously if there's an increase of supply, or I guess an increased demand for the LP partnership in the private markets, that's going to most likely lead it to become more efficient, and therefore like less opportunity for the attractive valuations that have fueled their like 31% or something crazy annual over the last few decades. I was reading some of that shit and I was just like, that's crazy, especially with like such large amounts of capital as well.
Yeah, 100%. It's like, I know everyone wants to jump into it, and the retail investors are feeling left out because they can't directly invest. It's like, and it's funny because you see those like undertraded stocks on the ASX or like the US markets, and that's where you can get outperformance there.
Yeah,
and it's sort of the same thing with PE. But then once those stocks become popular, they generally get pushed to overvalued.
Yeah, like, for sure. Yeah,
buy now, pay later. Good example of that.
Is this in the news? You're way better to like short sell, not that. You know what I mean? Well, at least had a choice of buying and selling. Which one you probably go for if it's headlining like that.
The problem is, but like it's like let's say you got like a put option on Afterpay, like the premium would probably like price that in already, just because everyone's probably, well, not everyone, but a lot of the options traders here are probably more like sophisticated, and so a lot of them would expect Afterpay and stuff like that to go down. And then at the same time, it might just not go down because of the huge retail and institutional valuations. But it's all a mental game, I guess. If you hang in there or pick the right time.
Yeah. It's just so interesting, because then you have that perspective, and then the retail train keeps chugging along, and then the short position gets smoked.
Yeah, exactly. Especially a short, because there's no protection.
Yeah, it's fucked. I like shorted the US market a few months ago and got smoked, so learnt so much there. So it was great, but it was also, I was just like, yep, that's so funny.
Did you buy futures or something, or an ETF?
It was literally just the worst thing you can buy, a fucking leverage ETF.
Oh,
beat the US on the ASX, but I was just the things that I learned was more valuable than the capital loss.
Yeah, honestly, you just got to do it and try. Otherwise you'll never learn.
Yeah, exactly.
Yeah. Are we back in the main or? Oh wait, no.
No. I am in your group right now. Just wondering if you have any volunteers to discuss.
Just one of us or two of us?
Yeah, just one of you for a very brief 2-3 minutes discussion of how your discussion basically went.
Me and Oscar were discussing quite a bit, so we'd be happy, I suppose, if you want Oscar as well.
Yeah,
okay.
We just had a discussion. So.
All right, so James or Oscar, which of you read?
Sure. Just summarize it, and then I can maybe do a little bit at the end.
Yeah, sweet. Yeah, sounds good. Is it okay if we do it like that, half and half?
Well, you have just 2-3 minutes, so if you can manage to do that, yeah, sure.
Okay.
Leave it up to you, but try to just remain within 2-3 minutes.
Okay. Which question 1 or question 2? Or?
So you are basically doing question 2, right? And these two, basically.
Okay. Yeah, that's great. We had some good comments there.
Okay. Thank you. Looking forward to it.
Sweet. No, I don't want to just one of us to do it and then the other person doesn't get a mark or whatever. I don't know how he's doing it, but
Yeah, for sure. Yeah, I guess I'm not that worried because I'm going to present next week. But
sweet. Yeah,
we're going to throw stuff out. But I didn't even realize it was supposed to be doing 2. We just sort of talked about it all.
Yeah, fuck. Well, it didn't take that long to talk about. Just a few comments.
We just run through it.
Yeah. What's your Is your Facebook just your name? I'll give you an ad.
Yeah, it's just my name. Yeah. Easy.
Too easy. Yeah, I think those, because there's also a BBOS one for the Aussie market.
Yeah. My mate did BBOS and I did UA.
Yeah, I had a few mates who did BBOS and they also got smoked because it was the rebound, after the crash.
Yeah. Oh, it was the bear market bounce that turned into a fucking bull.
Yeah, it was fucking ridiculous.
But
yeah, if you just bought anything in that bear, you would have made money. Doesn't matter. As long as it was long, you bought anything.
I went long on Qantas. I didn't do as much fundamental analysis as I should have, but it just so happened that luckily it was the day before that it bounced 30%.
Oh yeah, that's mad.
I was just yo, why didn't I buy more?
Yeah, I sort of started trading around the crash, so worked out as well.
Yeah.
You just dollar cost average it because you if you got no money in there, you have plenty of money to start doing that sort of thing.
Yeah, that was my plan, was a dollar cost average, and then that sort of gets smoked as well because you got heaps of capital on the outside and you're just But definitely just a good learning experience.
I think no point regretting it right now because you got time anyway to
Oh yeah, it's all inconsequential. It's just all skill development.
When you're managing a big P, you're making 3 mil a day,
That's the plan. Easy as that,
Yeah, it is. You just jump in, man.
Yeah. Alrighty. Let's put a few points down for number 2.
Yeah. So we said, what did we say? We said more screenings needed because of the ambiguity of investing in overseas markets.
Yeah. There's like, how has it made international private equity investment so answer that explicitly? It's just like, as was the case with basically all of their investments, they employed active managers that followed their investment thesis, that would agree to follow their incentive structure, basically everything that they wanted. These are like really scarce because of a lot of, corporate governance, and then obviously like the regulatory risk.
Yeah, they didn't really do it much. Like I think they did it. The only mention of an investment was the Russian one.
Yeah.
That was it.
It seemed lucky that they took the money off.
Really good timing.
Yeah.
All right, welcome back, everyone. The main room. If I can please ask for everyone to just turn off their microphones so that we can start with group 1. Michelle would be discussing how their discussion went in terms of question 1.
Cool, thank you. Our discussion was really good, so thanks to all my group members for being very active. But yeah, so the first question is explain the differences between Yale's strategy in each of the asset classes. So one of the first, differences I'll note is that in private equity, they had a focus on these long-term relationships and long-term investment horizons, whereas in real estate, they were more medium-term. Another similarity between all three is that they have this common strategy of focusing on value-added creation, and in private equity, they really like to invest in firms that were creating value in each of the businesses they invested in instead of making a quick entry and exit profit. In real estate, they were looking for, investors or businesses in really niche real estate areas that were more focused on value creation of the specific contrarian segments that they were specialized in. Furthermore, in natural resources as well, they entered partnerships on this value-add approach. So, for example, they would invest in oil fields and with the view to make them more efficient and profitable. So that's one similarity, between all of them. But also where they differ is that each of the segments obviously have their own different risks. In private equity, they're actually really well placed as experts to really hedge their position in the private equity sector. For example, with Snapple, when that tanked, they're pretty much able to use derivatives to limit the downside risks of the exposure. In real estate, they struggled with finding the right type of firm to really execute their investment strategy. This happens because in real estate, a lot of the firms, they make their money off of transaction fees, which is really misaligned with their view that the incentive should align with what they're looking for. So yeah, they kind of focused, they do rely on, investment specialists in that sector as well. So yeah, those were some of the differences that we picked up. Also the fact that real estate and natural resources, there's more exposure to things like inflation and changing commodity prices. Towards the second question, which is about how the investment office decides to make private equity investments, I've already covered a few points, but to go into more detail, they firstly place a premium on building long-term relationships, and this isn't specific to private equity, but in a number of their other asset classes as well. So they have a particular type of organization that they really like working with. Those tend to be independent, entrepreneurial, and small companies that are very well incentivized with creating a lot of value for their clients. So another point is obviously properly aligned incentives. Now, this has been, a basis for Yale to reject the services of many firms because they feel like affiliations with larger organizations are just problematic. For a number of reasons: conflicts of interest, insufficient incentives for the people actually doing the deals, and they have a strong preference for a model where the management fees cover ongoing costs, and they're pretty much incentivized to make all of the economic returns from the actual investment performance. So those two are really, I guess, key criteria when it comes to selecting a firm that they like, which is very specific. And thirdly, which I covered before, was also that they take a value-added approach. One interesting thing is they look for value-added operational experience. So they kind of look for very strong professional performance in all of the experts that they work with. And there's a very valid argument when they say that financial engineering skill is a commodity, as in, it's readily available and cheaply priced. So yeah, I guess those are, three main points that they use when they decide to make a private equity investment.
All right, thank you very much, Michelle. Ashwin from Group 2, do you have anything to add to that as well? Ashwin, can you hear us?
No mic, sorry.
Okay, no worries.
All right, so thanks, Michelle, for her contribution and her group's contribution. My group had a couple great points in the fact that there's a bit of some asset classes have sort of similar strategies to others. So like private equity and stocks sort of have the same strategy in the sense that you kind of have independent managers doing their own stuff, and they're the ones that execute the strategy and everything. Meanwhile, natural resources and real estate are sort of like a co-ventured, has like co-ventures and everything. So you're sort of in it together. You're part of the development of certain like forestry assets, or like say strip malls for a sense. And if you go a bit deeper into stocks and private equity, stocks is primarily focused on the quantitative analysis of how a stock performs and like mean variance analysis. So like when they move to private equity, they don't really Yale doesn't focus too much on financial engineering because that was quite easy to do. But what they really looked for in a manager was sort of an X factor, which was the ability to build successful corporations and a young, hungry team that was able to do that. In a sense that also another key criteria was that they didn't really look for big names as well, because real estate was sort of like very key, well-known names on the street formed by like the Illuminati and everything, but they sort of looked for a smaller set of like a couple of exclusive funds that didn't choose to increase the amount of their funds by incredible amounts. Because when you sort of have funds growing at a great pace, they're likely to make less risky investments that are likely to create the return, rather they're looking for a follow-on fund, which is not really going to bring Yale the best return. And in terms of deciding when to make private equity investments, this is more of a long-term play by Yale's endowment fund. They're looking for managers that just are able to continue to build firms, and it's more on the execution of the fund manager, not rather the Yale's choices. Yeah, that's what we came up with.
Yeah, thank you very much. I think that you both groups covered almost all the points in terms of the investment strategy, and kind of covers what I had to say, so I wouldn't repeat those points, and I think I can now directly go to question 2, and I'll ask group 3, James and Oscar. I think they want to do a collaborative presentation, so yes, the floor is yours.
Yeah, so I'll just start off. So in terms of how they've actually made international private equity investments, it's been pretty limited, as while they do want to apply the same strategy, looking for similar types of managers and firms, such as those who follow a good incentive structure where returns is the measure of performance. The big issue is actually finding the background of each manager, as the information available overseas in developing markets, for example, isn't near the quality that's available in, for example, the UK or France, where they were initially investing. So a lot of the challenges, they've really had to overcome this by more screening in their international private equity investments. And so this has sort of slowed down, the number of deals that they've made. But a couple of interesting ones was the Russian quasi-private equity fund. So this was a bit of a mixed bag. So the first part of it, this is where they took stakes in thinly traded public corporations and private companies. So they enjoyed good performance in the mid-1990s, but then the Russian debt crisis occurred in 1998. They got out of this a bit before, I believed. However, if they were to stay in, that sort of highlights the risk associated with international investments. So overall, it's definitely a larger degree of scrutiny that needs to be taken in all aspects of it. Did you want to add anything, Oscar?
Not really, but also just for the international private equity investments, they didn't really undertake many leverage buyouts, as was popular with the other endowments. And basically, like mirroring what we spoke about in the previous question, they were concerned of the incentive structures, as a lot of the foreign active PE managers worked under the control of the large financial institutions. And it, again, basically mirrors a discussion of basically every other asset class that Yale had in their portfolio. And we weren't completely sure of the reason, but we can basically discern that the underlying reason is due to the short-term incentive structure that is common in these large financial institutions, just like the manager bonuses and the quarterly goals and achievements.
Yeah, they sort of target safer investments as opposed to the ones with smaller amounts of capital.
Yeah, exactly.
And one other thing I'll add is like the government oversees the property rights and corporate governance isn't as like set out in legislation like it is over here, for example, or in developed nations in general. So that also adds another risk that, makes the argument for extra scrutiny when they're doing this. But yeah, I think that was pretty much it.
All right. Yeah. Thank you. Thank you very much, James and Oscar. I think we also covered all the points for question 2. And especially I will, in question 3 and 4, I'll just discuss very briefly the points you made also about the transparency and also probably a bit of differences between developing economies as well as developed economies, and what are the implications for Yale. So yeah, I would not repeat question 2 and 3. So question 3. Thank you everyone. Thanks Michelle, Ashwin, James, and Oscar. And for question 3, we want to have a view of the private equity industry as a whole, and basically how could current strategy, how could the chief investment officer's strategy, Swenson's strategy, how may it possibly go wrong? So I personally identified 3 themes that private equity is basically changing. The first one is that the industry as a whole is expanding. There is more competition, as we discussed earlier in the session. There is an influx of funds, especially because pension funds have become more active in this industry. And this means that there is a larger supply of capital. And this means that the fund incentives are relaxed, the fund covenants are relaxed, and most likely it would lead to lower quality deals. The consequence for Yale would be that past returns cannot be replicated easily anymore, and this means that there would be lower, if not negative, returns. The second theme is about the disintermediation in private equity investment. So we would be facing more competition from crowdfunding incubators or accelerators or angel networks. So private equity and venture capital is no more the only source of funding for a lot of startups, a lot of new ventures. That is why we can expect a lower fee and carry in the private equity industry, as well as, again, lower or negative returns. But there are really good growth opportunities in international private equity markets. More countries in developing markets are investing, and also a lot of developing economies, they are actually quite innovative. And this is basically the potential, the seeding ground that you need for growing a private equity industry. However, Yale in these markets is at an informational disadvantage. Yale, one of the key characteristics of Yale Endowment is its reliance on its strong alumni network. Yale has some of the best graduates in United States, and this alumni network, they are powerful, well-connected people. So I think that because of losing this alumni in other countries, they would already be positioned at an informational disadvantage. And it's very important to bear in mind that in private equity venture capital markets, networks and connections, they play a very, very key role. And if you don't have access to that resource in other economies, in other markets, that might cause some problems for your strategy. Also, Swensen, he has a very deep emphasis on incentives, meaning that, and this means that some emerging market funds are not compatible with incentive schemes that he looks for. And in general, this again might mean that Yale may miss opportunities in emerging markets due to its philosophy. Ashwin is asking, so what exactly, can you be more specific in the interest of time? So if you can be more specific about your question, and
yeah, so what I picked up was that, like, some people were able to, like, negotiate better fee structures and stuff. So it was a bit Swensen was a bit like disagreed, like wasn't too happy with that. Why would that sort of be?
With having different incentive structure or different deals in general?
Yes, just different fee structures for different firms.
Yeah, so I think one problem that having basically being inconsistent in terms of your fee structure would cause is that because you are very much reliant on this network of private equity funds that you're investing in, it would kind of lead to an unhealthy competition amongst them. If you are paying someone more than the other, or the incentive structure is not really the same, it would mean that this kind of discrimination, I think it can lead to some potential problems, because we should bear in mind that Yale already does a very thorough and complete analysis and monitoring of these private equity funds. So if after all of that, and private equity, it's a very you can say risky, and there is a lot of uncertainty attached to its investment. And if you add another component of like discrimination for businesses that are already dealing with a lot of uncertainty and have already gone through a very thorough monitoring process, I think that would not help you as an investor. So that is my understanding why it can cause problems. But if anyone else has anything more to add to that, I would be happy to hear it after the class. So let's just finish with this slide, and if you want, we can continue the discussion. So the last question is about the future strategy of Yale. So whether the investment office should shift this private equity strategy. So the current strategy, it's about building relationships with top-tier venture capital or private equity funds and utilizing the Yale alumni network, something that I just discussed. It's also focused on incentives of fund managers, on domestic market, where Yale has an informational advantage, and also on avoiding market timing. In terms of emerging markets, this would require a shift in the strategy, especially in terms of incentives and informational advantage. Well, yes, emerging markets, they have potential for higher returns. That's a plus for them. But we should also consider this lack of proper incentive structure, as James and Oscar pointed out in their presentation. There is a different mindset about governance, and that would make it harder for Yale to basically implement its incentive structure. It's also difficult to develop quality relationships and evaluate the track record of managers, which is a strategy that Yale has. Can Yale adopt other strategies, for example, market timing? Well, it requires a complete shift in the mindset that Yale has followed so far. I am not too sure if that would be the case, but yes, so that is something that I don't think that would happen. But if private equity markets do not prove to be as profitable as they were before, maybe this is something to consider. Excuse me. So I see that it's 4:30. We are basically at the end of the class. I'm sorry that the end was a bit rushed today, but because we had to go through the assessment structure in the beginning, and I think we can end today's session here. I hope you had you have a better understanding of how Yale does its investment, and also a better understanding of how this course is graded. If there are any questions, you can stay. I will stay for a couple of minutes. Otherwise, have a very good day and goodbye.